So here is an example of some of the biases that investors fall prey to. Overconfidence is probably the most typical one. And the way overconfidence manifests itself with investing is through overtrading. People that are overconfident have a tendency to trade more. And there is evidence that men exhibit this bias more than women. There's a great study by Terry O'Dean, Boys Will Be Boys, Gender, Overconfidence, and Common Stock Investment. But they found that women just weren't as confident as men. So they traded less. Because they traded less, they had less transaction cost. And so they had higher returns than men. Loss aversion is the people's tendency to avoid losses to acquiring the equivalent amount of gains. So a good example of that would be if I ask you to engage in a coin toss with me. And I told you that if I tossed a tails, you were going to have to pay me $100. And then I ask you, but if I toss a heads, how much do you need me to pay you to accept this bet? Okay? Most people require 2 times the amount. So most people would require me to offer $200 if they're going to risk losing $100. So that is loss aversion. Confirmation bias and anchoring is pretty simple. It's that people tend to read what they believe. They look for companies that are saying the things that they already believe. They watch news stations that tell them things they already believe. They read news articles that say things they believe. In my family, my grandfather was a staunch Republican, and he always subscribed to a liberal newspaper. We're like, why do you do that? And he said, because I want to read and understand the other person's point of view, so I can see the flaws in their argument. And it helped him understand his beliefs more by doing that. Mental accounting is the tendency for people to separate money into separate accounts based on subjective criteria. So a good example of this would be, they see this with gamblers in Vegas all the time. People come in with money, they put it down on the table, they win some. They take their winnings, they put it in one pocket, the money they came with in another pocket. They actually separate the money, and they do really different things with that money. The money they won is why all those shops exist around Vegas. They go buy fancy handbags and eat fancy dinners. But they don't do that with the money they came with. That makes no sense. All money is created equal. But you see this in the stock market. It's called the found money effect. So investors invest capital, they make some money, and they've got that found money effect. So they start taking a little bit more risk when they invest it the next time, because it's like, found money. And then herd mentality is simply that people are social animals, and when they're faced with uncertainty, they rely on something called social proofing to make decisions. A good example of this would be sitting on the interstate prior to cell phones, and you see somebody get off you're in a traffic stop, and you see somebody get off at an exit, and then somebody else, and you think, I bet they know something I don't know. Should I follow them? That's what they do in the markets. When you haven't done your own research and you don't understand your investing, and you see everybody run for the exit, you know what you think? You think, I bet they know something I don't know. I want to live to see tomorrow. I can't handle it anymore. I'm going to get out of the market. We hear professional investors and investors in our company say that exact phrase in bear markets. They say, I just want to live to see tomorrow. When you hear that, you're somewhere near the bottom. These people are really uncomfortable. And usually they can't stand it, and they take their money out of the market. It's always a bad decision. I've never seen it be a good decision.
Hi, it's Lauren Templeton. It's a beautiful day in Tennessee, and I'm sitting here enjoying my new copy of Value Investing Simplified by Cayden Chang. It's a great book. I hope you pick up a copy and enjoy it yourself.